Real assets are being completely repriced in real time, and the super cycle for commodities is just beginning. But this isn't about oil prices. It's not about copper charts, and it's certainly not about the next big trade. This is about a commodity super cycle, the size and scale we've never seen before. And if you don't understand how it forms, you'll either miss it entirely or you'll just be buying it at the top. Because super cycles don't start with headlines. They start with underinvestment, liquidity stress, opportunity costs, and repricing of risk really quickly. Now, by the end of this video, you'll see where that pressure leaks, where the option market exposes it, and where the volatility and opportunity goes vertical. So what is actually a commodities super cycle? Let's be entirely precise and let's frame it properly from the get-go. A commodities super cycle is a multi-year repricing of real assets: gold, copper, industrial metals, base metals, ferrous metals, rare earths, driven by a few things. Structural supply constraints, like we've never seen before. Supply that is not secure, supply that is unstable, supply that is unpredictable. Politically protected demand is another feature of these kinds of markets. So the politicians realize that the next boom is in AI, or weaponry is needed to be secured, and they position accordingly. And it also manifests as physical bottlenecks. Countries like China and South Africa and Russia preventing assets and metals and rare earths being actually procured. It's not a trade, it's not a positioning thing, it's a regime shift entirely. Super cycles can be very profitable if you're on the right side, because they last typically between 10 and 20 years. But they don't reprice absolutely everything. They reprice what the systems cannot replace very easily. That matters in this kind of cycle. That matters in an economic boom and in a super cycle of this nature. This cycle is centered on three groups. Number one is energy. Oil, nuclear, wind power, solar, natural gas, power generation inputs, securing the grid, modernizing the infrastructure and securing it for the next generation in terms of capital expenditure and how AI is going to be powered. Energy is always the base layer. Without it, nothing is ever going to scale. Next is going to be industrial and monetary metals. Copper for electrification. How do we position in copper positions? Silver for the energy and the monetary hedge. How do we position using options in silver? Nickel, lithium, zinc, infrastructure metals. How do we get exposure to these exotic and rarely traded low liquidity environments? And of course, gold, the monetary anchor during liquidity stress.
Lots of gold. Where's the print?
We would be remiss if we didn't mention optionality and opportunities to trade in strategic and rare earth metals. Rare earths, uranium, especially inputs tied to defense, AI, energy, and reshoring. These are the critical elements that we can be trading and positioning our portfolios to benefit from in the future. These assets all share just one trait. Supply cannot respond quickly, even at higher prices, even when mines are incentivized to actually produce more of the metal. They can't be done easily and readily. These assets all share that trait. That's where the gamma optionality and the convexity in the option prices really lays. And that's where we can position our portfolios and ourselves to really get exposure and benefit from that bottleneck, that convexity, and that asymmetry when it comes to the explosivity of these trades. So we've had a few super cycles in the past, but this one is definitely different. Previous super cycles were always driven by a different plethora of attributes. China industrializing, globalization, cheap capital. That's not the same thing driving the super cycle that we have today. This one is driven by something entirely different. It's driven by deglobalization, the opposite of what the first one actually caused. It's caused by energy insecurity. It's caused by political mayhem. It's caused by artificial intelligence, capital expenditure. All of these things are what's driving this AI cycle. Not to mention the strategic hoarding of these metals and these assets, because governments realize in the national security interest that these metals are scarce and that the supply bottlenecks are existential. There's also monetary dilution that's occurring at a pace that we've never seen before. In the last few years, more money has been printed than has been in the last 25 years in its entirety. So the monetary dilution is what's also spurring on these trades completely. What does that mean? Demand is politically protected, not economically optional anymore. Governments won't counsel big grid upgrades because copper is expensive. That's not how it works. And data centers won't stop building because energy costs are rising. Price becomes secondary in these markets and access becomes everything. They become price agnostic, price inelastic. They have to buy it. And that's why a super cycle in commodities can really make your portfolio grow 10x, 20x if you position correctly. The real threat here isn't FOMO, but it's if you don't pay attention whatsoever. If you sit in cash, in bonds, or purely financial assets, you're not going to be able to benefit from the super cycle and the scarcity. And scarcity reprices absolutely brutally. And it doesn't mean you're impervious from it if you're just sitting in cash. The danger isn't the volatility. The danger is owning the claims on the constraints and not being exposed enough. Super cycles silently transfer purchasing power away from savers towards the owners of the bottlenecks, or even the people who are positioned to benefit from the benefits of the bottlenecks. That's how the systems all work. But why do options work out better for you in this paradigm rather than spot prices? Here's where most people actually go wrong when they think of exposure to a super cycle. They think, oh, okay, I'll just buy the commodity, I'll buy the underlying. But that's not always the best way to play it. Let's talk about what the best way is to play it. You're thinking, okay, I'll just buy the underlying spot commodity, Justin. That will give me exposure. Yeah, fair enough, it will. But spot markets move after optionality reprices. It's the tail that wagged the dog or the dog that wagged the tail. Option markets do three things really well, and they do it first. They test the narratives for you cheaply, they reprice the convexity risk, they force the dealer hedging, they increase the gamma moves, they increase the delta moves, and spot prices act as the headlines, whereas in options markets, options act as the mechanism. So it really is the tail leading the dog. And that's where you have the benefits of convexity and being able to expose yourself to these super cycles really effectively and cheaply. Because super cycles always begin quietly, and they begin with delta moves. Early in a super cycle, volatility is always cheap because no one really believes in the narrative. The belief is low, the trust is low, the faith is low. The regime that you've had for the last 10 years seems to be the one that's going to continue forever. Belief is non-existent sometimes. Price action is boring. The price action doesn't inspire everything. It doesn't show you that, hey, there's potential here. It's mispriced. We're trading below VWAP. We're trading below all of these RSIs. It doesn't show you that, hey, there's a new movement, there's a new regime coming in. And that's why volatility is so cheap and people ignore it. Makes sense. That's though when institutions use low delta long-dated calls. Why? Because delta exposure is without commitment at that stage. Mechanical. That's how it works. The institutions reprice the risk, they see how low it is, and they wonder, hey, 12 to 24 months calls on copper, on oil, on metal producers, they have a low delta, they have limited downside. Explosive upside if the narrative actually sticks. So what do? They get that cheap optionality. They arbitrage that cheap optionality and they really benefit from it. Delta lets capital probe the future without the balance sheet risk. And that's how you can really exploit it as an institution or as an individual. If delta is where the optionality can be expressed cheaply, then gamma is where things stop behaving politely completely. Gamma measures how fast the delta changes for every $1. When dealers are short gamma, rising prices force them to buy more. Falling prices force them to sell more. So you can see how it has an additive effect rather than a substitutive one. In commodities, that is completely lethal because repricing is absolutely brutal. Supply can't respond as fast as you can with normal paper financial assets. That's how you get oil spiking for no reason, or headlines in the mainstream media that says, we don't know why it happened. It just spiked on some uncorrelated report that everyone's like, why did that spike it when normally that wouldn't have any effect on it? And it causes this recursive loop that keeps on feeding itself. Copper gaps on no inventory change or no news out of China. It's just gapping for no reason because the supply can't be secured. Mining equities that triple without any earnings growth just coming out of nowhere, and you have some analysts on Wall Street saying that, oh, it's because they have a new CEO. But no, Gamma doesn't care about the fundamentals. It just cares about the hedging math. That's how it works, and that's how the explosivity actually occurs. So if you're talking about exposing yourself to a super cycle, you need to be thinking about the explosivity of Gamma after you positioned yourself in the delta. But we can't go away without talking about theta, which is the cost of that expression, the cost of that belief. Theta is your time decay. Theta is what kills you if you bleed away slowly, like a hemorrhagic patient. In early cycles, theta is always cheap. In long-dated options, theta is always cheap. Volatility is always mispriced. Owning time makes sense in that environment, right? But late in cycles, when the movements are most explosive, or when everyone is on the boat, or everyone's on the same side of the balance sheet and the same idea, the theta becomes really prohibitive. It becomes punitive. Everyone believes the story. Everyone and their Uncle Larry is in on the trade. Everyone is trading on the exact same side. Optionality is expensive. That's why shares in MicroStrategy can be trading at a huge premium, even though everything's going down in the Bitcoin and the crypto space, because the belief is still there. Theta tells you where you are in that narrative, not where you are in the trend. If theta feels painless, belief is probably low. If theta feels really cruel and prohibitive and punitive and expensive, then belief is crowded in the thesis. Now you can exploit that. You can exploit that crowdedness with mean reversion strategies, or you can exploit it by if you think that the pricing is mispriced, or that the risk is overplayed, or that the cycle has more legs in it or more way to run. Convexity is priced in all of these Greeks. And it's why small changes really mean a lot. Convexity is why super cycles always shock people, because linear thinkers think if demand rises 5%, then prices are going to probably rise 5%. But convex systems don't work in a linear fashion. They do something else entirely. Marginal demand is going to strain the supply, so the options are going to reprice with complete volatility embedded. Dealer hedging is going to amplify the moves, and the cycle is going to become recursive, and it's going to become very painful. And at that stage, the narratives are completely going to reinforce themselves. So you get these cyclical moves, you get these moves that can run for longer than anyone anticipated. You get these moves that they seem detached from reality, because AI, if you think about it, it doesn't need to double on copper demand. It just needs to stress the system at the margin. The marginal input that can't be secured in time, the copper, the palladium, the platinum, it just needs to stress it enough at a specific time for it to be so stretched that no one can procure it, and then it's a mad frenzy to actually procure the things. And that's how convexity breaks the models. And that's what happens in a commodity super cycle. If theta is the cost of the belief, theta is the cost of being in the market, then we also need to recognize that that means there's a clock to every regime. There are your monthly expiries, there are your quarterly expiries, there are your year-end maturities, there are your leaps, long equity appreciation positions. And if you're a real degenerate, there are the zero DTEs. So when open interest clusters around certain prices because people are thinking, oh, it's going to get to 6,000, it's going to get to 7,000, dealers are going to be short Gamma. Or when liquidity is thinning out, moves don't just drift, they snap, and they snap aggressively and they snap violently. And this is why a commodity cycle feels manipulated. People say it's manipulated. How did it go up like that? But no, it's the actual plumbing. It's the actual infrastructure. It's the open interest clustering. It's the psychological levels. They aren't being manipulated. They are mechanically constrained. Think about the bottleneck in a real physical market being expressed in optionality. Now, all of this leads me on to what really is going to be a catalytic additive to this whole commodity super cycle, and that's artificial intelligence. AI CapEx is going to be the perfect storm in the perfect super cycle, because AI is the perfect accelerant for a few reasons. It justifies unlimited spending, it's sanctioned by government, it's sanctioned by militaries, it's politically untouchable, and it requires actual resources. We're not talking about financialization where you can express opinions on paper. We're talking about, in some ways, quite archaic building of things, but obviously very advanced things. We're talking about steel, iron, copper, palladium, gold, silver, all of these things, because the data centers behind powering the AI are going to need vast amounts of minerals, vast amounts of labor, vast amounts of metals, vast amounts of energy, silver, gold, palladium, grid infrastructure, copper, iron, steel. Even if the AI hype fades, and it probably will at some point, the CapEx doesn't ever reverse to the mean. There is going to be no CapEx that returns and says, okay, can't stop spending now, even though we've baked in 200 billion to 1 trillion of capital expenditure. It's just going to be spent. Narratives never need to be permanent. They only need to last longer than the option expiry. Be completely honest. If you're a trader or an investor or a portfolio manager or a CTA, then everyone wants a commodity super cycle. People say, I believe in real assets. I believe in hard assets. I don't believe in financialization or assets that aren't backed anything, until copper drops 15% in a week, and then suddenly everyone's like, this market feels rigged. Or when silver drops 40% and everyone says, I knew it, the big banks are manipulating it. But that's just the convexity. That's the cost of being in a super cycle and the volatility that comes along with it. And that is going to always happen when the math meets scarcity. And in commodity super cycles, the scarcity is a feature, it's not a bug. And in fact, it's the way that we make a lot of money in the super cycle if we're positioned correctly, using options, understanding the deltas, understanding the gamma, appreciating the theta. Appreciating that theta is the cost of your belief, the cost of your thesis. Because a commodity super cycle isn't a prediction, it's a structural repricing of that scarcity. Options, they can't forecast it, but they do definitely reveal it. And when the regimes change, when they change, the Greeks move first and they move fast. That's how it all works. By the end of this video, you've seen where the pressure leaks and how the system quietly forces price to follow. Now, if you like this, let's watch my next video where I'm going to talk about the specific plays in the AI super cycle and the specific options.